Hello everyone, myself Pavitra, Assistant Professor, Department of Commerce, St.Josephs College of Arts and Science for Women, Hosur. Today topic is Introduction of Verification of Assets. Agenda: Introduction of verification of assets, objectives of verification of assets, difference between valuation and verification, verification of liabilities, valuation of assets and liabilities, verification and valuation of assets. Introduction. One of the most important duties of an auditor in connection with the audit of the accounts of a concern is to verify the assets and liabilities appearing in the balance sheet. The auditor must satisfy himself that assets really existed at the date of the balance sheet and free from any charge, and that they have been properly valued. In verifying the liabilities, he has to see that all liabilities have been sorted at their proper figures and that no liability has been omitted. In simple words, verification means providing the truth or confirmation of valuation of assets and liabilities. So, verification of assets appearing in the business is an important duty of an auditor. This duty of an auditor has been upheld in many classes. For instance, in case of London Oil Storage Company Limited versus Sir Horslock and Company, it is said that it is the duty of an auditor to verify the existence of assets stated in the balance sheet, and he will be liable for any damage suffered by the client if he fails in his duty. Again, in India, this duty has also been imposed on the auditor by the Companies Act. So, verification of assets includes the following. First one, existence of the assets, legal ownership and possession of the assets, ascertaining that the assets is free from any charge, and last one is correct valuation. Objectives of verification of assets. So, first objective is to verify whether the value of assets shown in the balance sheet are valued as per generally accepted accounting principles. Second one, to verify whether his client is the owner of the assets shown in the balance sheet through legal and official documents examinations. Third, to verify the existence of assets shown in the balance sheet through physical examination of the assets. Fourth one, to verify whether the assets shown in the balance sheet are under the possession of his client. So, fifth one, to verify whether the assets shown in the balance sheet are free from any charge or lien. If an auditor does not perform his duty of verification of assets properly, then he will be held guilty of negligence and will be held liable to his client for damages. So, meaning, verification means checking whether the assets shown in the balance sheet or in the name of business, whether they exist or not, or whether there is any charge on it, etc. So, valuation means determining the proper values of assets and liabilities shown in the balance sheet. Nature of work is, so verification examines the assets and liabilities shown in balance sheet. Valuation examines the entries relating to the transactions recorded in the account book. So, second one is time. So, verification is made at the end of the financial year. So, valuation is done for the whole year's transaction. C is purpose. The purpose of verification is to check existence, ownership and possession of assets. The purpose of valuation is to determine the proper values of assets as per generally accepted principles. The third one is basis. The basis of verification is the type of assets and liabilities. There is not fixed method of verification. The basis of valuation of assets is the types of assets are valued on different bases. Next, personnel. Verification is done by auditor himself or his assistant, whereas vouching is done by juniors like audit clerk. Next one is certificate. The auditor is not able to get certificate of verification of assets and liabilities. The auditor is entitled to get certificate of valuation of assets from responsible officer of the business unit. Next, vouching. Vouching verification includes, valuation does not include vouching. Next, scope. The scope of verification is wide. It includes checking of many things like existence, ownership, possession, etc. The scope of valuation is limited. Here, only values of assets and liabilities are determined and checked. Next, verification of liabilities. So, it is necessary for an auditor to verify the liabilities to ensure that the business represents the true and fair view of the state of affairs of the concern. The importance of verification of liabilities by an auditor with reasonable care and skill was emphasized in the case of Westminster Road Construction and Engineering Company Limited. Object is to see that all the liabilities of the client's business are disclosed in the financial statement. Second one, to see that all the liabilities of the client's business are properly valued as per generally accepted accounting principles. Next, to see that all the liabilities of the client's business are properly classified and disclosed. Fourth one, to see that all the factitious liabilities are not disclosed in the financial statement. Fifth one, the auditor will be liable for the non-disclosure of certain liabilities in the business, even though such liabilities were not recorded in the books of account provided, if such liabilities could be detected by the application of reasonable care and skill. Valuation of assets and liabilities. It is a fact that an auditor has neither technical knowledge nor time required for the valuation. Therefore, an auditor cannot be expected to do the valuation. It should be done by the owner of the officials of the business. An auditor has to make an inquiry into the valuation and satisfy himself that the values are properly determined. So, verification and valuation of assets includes goodwill. Goodwill is an intangible asset, therefore it can be verified from records only, and it cannot be verified physically. As per accounting standard 10, goodwill shall be recorded in the books only when some consideration in money or money's worth has